Andrea, thank you very much for joining us all today. As a firm, we've had a bullish view on growth and the fundamentals for some time now, and had a long bias in terms of asset allocation. And we've expected a so-called melt up in 2018. But what we've seen so far, particularly in equity markets in the early weeks of January, has been beyond what we expected. It's been a stunning performance so far. Have we already seen too much of a good thing, and have the investors already realized gains for 2018, or is there more to come?
Well, the performance in equity markets has been quite stunning so far this year. We don't think that the gains for the year have been realized already. We think that some of the performance is due to investors taking off risk from the table at the end of last year. We've seen that in the data, in volumes dropping even more than they normally do towards the end of the year. And investors were sitting on very nice profits in 2017, so it made sense to cash them in. So obviously, since very little has changed so far this year, investors have repositioned for a continued bullish view for the rest of the year. But volumes so far have also been well below the 10-year range. So it doesn't look as if investors have turned much more bullish than they already were towards the end of last year.
Okay, so we had a kind of a technical pause, and now the rally's continuing as it would have done.
Exactly. So there are some fundamentals at play, but there's also technicals, as you said. So if you look at CFTC data, for instance, that shows that investors are net long, but not obscenely so. So the Z score for the S&P 500 for the S&P mini futures, for instance, is less than 1. So yes, long, but not extremely so. But obviously, the risk of a short-term pullback or some consolidation phase is quite tangible. If you look at technical indicators such as the RSI, the MACD, they're all at extreme levels. But looking beyond this possible consolidation, the central case for us remains for positive returns for the equity market. Again, the central case is that the returns will be roughly in line with EPS growth, which we expect to be in the sort of low teens. And of course, it will vary across markets, but we would be very surprised if it were, not in the low double digits. But there are obviously downside cases and upside cases. So the downside risks, they lurk in the usual places. It could be a policy mistake. It could be inflation picking up quite significantly, or it could be the usual politics, geopolitical risks, which we think have come down in terms of probability compared to a year ago. On the other hand, the upside risk is what we were talking about earlier, which is an equity market melt up and potentially a bubble developing this year.
Okay, so we'll get into some of these risks, some of the upsides that we might anticipate. I guess given what we've seen in the first few weeks of the year, let's try and pin down where we are today. So are we already in a bubble?
No, we don't think so. We've been talking about this for some time, and I think it probably makes sense to stress that point once again here, just very quickly. So if you could please take a look at the slide number 3.
Rational exuberance.
That's right. So this is a long-term history of the Shiller's cyclically adjusted PE ratio, or CAPE for short. And we clearly see that the PE ratio, this CAPE, is well above the historical average. But should this measure revert to the mean? And our view on that is that it shouldn't. In fact, if you look at the time series, you can clearly see a gentle uptrend over the last 150 years or so. And why is that? Well, we think that the main reason is that there have been clear historical periods, the most important of which is what we call the short 20th century, between the First World War and the end of the Cold War. During that period, we had a series of events, 2 world wars, the Great Depression, the Great Inflation, and the rise of communism, with the associated risk of confiscation, that, in our view, depressed risk premia to an extent that is not comparable to the situation we have today. So comparing today's CAPE or PE ratios to the PE ratios prevailing in that period, we think is not warranted. So we tend to look at the post-Cold War period. But even in this case, the average CAPE is about 25, and we are well above 30. So clearly valuations are above average, but they're not bubbly as they might look just looking at the whole time series. The other thing to point out is that PEs are not supposed to be mean reverting because they're driven by underlying factors such as earnings growth and interest rates. And the most important factor in this particular moment in time is interest rates, which are, of course, very close to historical lows. They've come up a little bit in the last year or so, but they're still very low. And given that low interest rates means a higher present value of future cash flows, well, it's completely justified that you should get higher PE ratios, everything else equal.
Okay, so low interest rates have been providing the conditions for cheap liquidity. That's been a prop to boosting asset prices. We're expecting 3 Fed hikes this year. We were expecting that, have been expecting that for some time, and the market's now starting to price that in. We are perhaps off consensus in suggesting that we think the ECB may hike rates within the year at the December meeting, having ended QE in September, and we're slightly earlier than the consensus for Bank of England. So the direction of rates is up. So what happens as rates rise? What happens to multiples then?
Well, of course, that's the next question, right? If rates were to stay low, then of course higher PE multiples would be justified. But what if rates go up, as they are indeed doing? To answer that question, one can either look at history, and history shows that multiples tend to fall as interest rates go up. But if you look at the most recent history, in the current cycle, we've seen the Fed hiking consistently since for more than a year now, and yet multiples have gone up. So we've taken a slightly different approach and came up with a discounted cash flow model for the S&P 500 to give a forward-looking answer to what happens if interest rates go up. So what we've done with this model, we kept it simple. We calibrated it to consensus free cash flows, which are available for the next 3 years. We've halved that growth rate for the first 3 years in the subsequent 2 years. So we made an explicit forecast for the first 5 years, and then assumed free cash flows to grow at a rate of 3% thereafter, which is a very conservative but a typically assumed figure. Okay. So using these numbers, the model level for the S&P actually coincides with the actual level of the S&P. So the model is calibrated to the market. So that's the starting point. So what we've done from there is to increase the cost of debt by 100 basis points to see what impact that would have on the weighted average cost of capital. And since for the S&P 500, 75% of the capital structure is equity, a 100 basis point increase in the cost of debt only increases the WACC, the weighted average cost of capital, by 20 basis points. And that means that the overall impact on the equity price is only 5.5%, which isn't much. Of course, it's sizable, but it's not a lot. And it corresponds to about 1 unit of PE. So sum up, 100 basis points increase in the cost of debt, whether it comes from credit spreads or it comes from treasury yields, would have an impact in theory, on the S&P price by 5.5%. So hardly a reason to be outright bearish, and easily something that can be compensated by earnings growth.
Thanks very much. And you've gone through a fairly rigorous analytical approach there. And in a more broader sense, there are hikes and there are hikes. So while we're expecting the Fed to hike 3 times, it's not the case that they're hiking to kill inflation and therefore will crater the economy. They're beginning a process of normalizing rates. So that liquidity will still be plentiful.
Exactly, and the tightening cycle is particularly out of sync with the market cycle in this particular moment, because the market bottomed in 2009 and the Fed only started hiking rates consistently in December 2016. So clearly the Fed is quite behind the curve in terms of making policy tight. So policy is still in absolute terms loose, and that's why in this particular episode, multiples, instead of decreasing as they normally do through a tightening cycle, they've actually gone up.
Yeah. Great. So conclusion 1 there was that we're not yet in a bubble. Follow-up question has immediately come in. Are we going to get one?
We think it's very likely, yes, because all the ingredients for a bubble are in place. And there's three main ones that we can think of. The first one is ample liquidity. Liquidity, of course, is going to get tighter at the margin. We know that central banks have become a bit more hawkish. The ECB will end its QE program most likely in September this year, and the Fed has already started doing QT. So the only one major central bank that hasn't started tightening yet is the Bank of Japan, but we do expect them to become less dovish as well. Yeah. But liquidity overall, not just central bank liquidity, is more abundant than it seems. And it's mostly down to credit markets. In a new monthly macro product we've recently started publishing, which is called Global Financial Trend, we try and go to the bottom of this and make this point in detail. Now, the second ingredient for a bubble is strong economic growth. Strong growth means earnings growth is likely to be quite solid as well. And as long as earnings continue to rise, the inevitable market bears will be silenced because, yes, they can make noise about valuations, but as long as earnings go up, it's very difficult to make a bearish case. And the third ingredient is a good narrative. And one has to look no further than Bitcoin to see the powerful impact of a good story on asset prices. And in this case, looking at stocks, it could be tech, which could be touted as a game-changing, paradigm-shifting factor that justifies ever-increasing valuation. And you can already see some creative valuations techniques in certain tech companies. You don't see that kind of irrational behavior on the market as a whole, but clearly in some specific cases, it is coming across already. And you know, the proponents of this paradigm shift will use the usual buzzwords or buzz phrases like, you know, blockchain, big data, artificial intelligence, you know, autonomous vehicles, you know, social media capturing advertising revenues and so on and so forth. So the bottom line is that late cycle dynamics, market dynamics, are increasingly starting to assert themselves, and we expect that to continue.
Yes, you mentioned a few, what I would interpret as contrarian signals from investors that have been through several cycles there. You've talked about paradigm shift, you talked about bear capitulation, new jargon and buzzwords. These are all things to raise alarm. And you referred there to late cycle dynamics. Can you please define what you mean by that? Because we're in a very extended economic cycle that we don't think is ending yet. So can you please define what you mean by late cycle market dynamics?
Sure. I think it's useful to look at slide 4 to make this point. And
okay, so here this is slide 4, fear of missing out, one of two.
That's right. So slides 4 and 5. So what we've done with this set of charts is to look at the past 13 market cycles, the past 13 major market rallies. And look at various metrics on average over these past 13 cycles. Now, the first one is that the last 12 months of a typical or the average market rally is worth about 20% in terms of total returns. Now, that's what, as an investor, you're leaving on the table if you believe that the market peak is at least 1 year away. Right. And of course, if this cycle is in line with the average, of course. Interestingly, if you buy into this assumption, again on average, if you buy today, you never go underwater because you ride the market all the way up to the peak, then the big sell-off begins. If you don't sell out at that stage, of course you suffer some losses, but you never actually go underwater, as you can see from the chart on the left-hand side on page 4. Now, again, this is on average and assuming that the market peak is at least a year away.
Yeah, and you're talking about market losses. You haven't mentioned redemptions.
Exactly, and also, of course, you can time it better probably than just buying today and staying invested all the way through. So, you know, with these, you know, if one believes in this premise, of course, the fear of missing out is starting to set in, and we've seen that already last year, and will probably continue to happen this year as well. Now, it's interesting to see how these 20% returns are actually delivered. And for that, it's useful to look at the chart on the right-hand side on page 4, which shows that it's mostly via multiple expansion. So in the last 12 months of the rally, about 2 units of multiple expansion happen with actually nearly one unit of multiple expansion, happening in the last 3 months. So that's the proper melt-up phase of the rally. Now, if you look at the chart on page 5, you can see that earnings actually tend to grow, obviously, in the run-up to the market peak, but the growth rate is actually quite poor. It's about 6%, which tends to be 5 to 6%, which tends to be a bit lower than the sort of long-term average growth rate for earnings. So you can argue that in the latter stages of a market cycle, earnings growth slows down, and particularly in the last 3 to 6 months, is definitely subpar. But interestingly, and again, on average, the dip in earnings tends to be quite short, less than 6 months, and quite shallow as well. But of course, averages conceal a lot of variance in different cycles we've looked at. And the big difference comes down to basically one factor, and that is whether the market peak was caused by a market event, i.e. valuations getting out of control and eventually investors selling off.
So collapsing under its own weight.
But the underlying economy continuing to do okay. Right. Just think 2000. Or macroeconomic kind of event driving the market into a bear market. And think 2007 for an example of this. And finally, the last point to make is that volatility, and that's the chart on the right-hand side on page 5, remains very low, with a few spikes here and there, until the sell-off begins. So although investors, it's quite a consensus view out there right now that volatility is going to pick up this year, and we kind of subscribe to that view to some extent, it is important to point out that yes, it might pick up from very, very low levels, but it won't get out of control until the market really peaks.
Okay, so until we get into that final 3-month phase when you get into a pure bubble territory, has some of this already begun? Some of what you've been describing, obviously, it sounds very familiar and current. Is it already underway?
Well, in a way it is. I mean, these kind of, as I said, late cycle dynamics have already started to set in. So if you look at page 6, for instance, called beta testing 1 of 2, you can see that the high beta part of the S&P 500 has already started outperforming the broader index for some time, from the start of 2016, with a bit of a wobble at the beginning of last year. So obviously, people have already started looking at higher beta names. That's definitely been taking place. And if you look at the chart on the right-hand side, you can clearly see that multiples have been expanding for some time in most markets, with very few exceptions. And this chart is for 2017, but it's the same if you look at the year before. So already for a couple of years, multiples have been definitely going up in most markets.
Right.
But again, going back to the chart on the left-hand side, you can clearly see that this sort of seeking higher beta names has been taking place for some time, but it hasn't quite reached the extremes that it had even in 2010 or 2011. So yes, the dynamics have already started to play out to some extent, but definitely we're not at the end of this stage.
Okay, and so what's the recommendations for investors right now then? How do you think people should position, given the type of environment that you described we're already in, and the type of environment that we think we're going to be going into?
Well, while it might not be entirely rational, we think that buying high beta stocks or markets and growth stocks, as opposed to value, should continue to pay off. To prove this point, again, looking at the past history, we looked at the last 2 major market rallies in 2000 and 2007. So what we've done is take the S&P 500 and looked at each single company's beta and valuations, looking at P, PB, and price to sales 1 year before the market peak. Then we ranked the stocks in the S&P 500 by these metrics and split them halfway. So we took the stocks with the higher than average beta and lower than average beta, and the stocks with the higher than average valuation and lower than average valuation. So this resulted in 4 categories: cheap, rich valuations and low, high beta, which you can assemble in 4 quadrants, which is exactly what we've done on the slide on page 7, which is called beta testing 2 of 2. And then what we've done is to look at the returns, the price returns for each of these categories in the subsequent 12 months leading to the market peak.
Yeah.
for both 2000 and 2007. And what clearly emerges is that high beta stocks tend to beat low beta ones, and rich stocks, perhaps surprisingly, tend to beat cheap ones. So, okay, this is not very different from momentum investment, and that's probably what's taking place. But it's nice to see it in the data.
Right.
One important conclusion of this analysis is that although these trends have been true for both the 2000 and 2007 rallies, there's a big difference in performance between rich and cheap and high and low beta between 2007 and 2000. So the variance in performance was much more pronounced in the 2000 rally than in the 2007 one. And that's because in 2000 there was obviously an equity bubble, we all know that, whereas in 2007 it was mostly a credit bubble. So in 2007, stocks really never had a chance to become overvalued, and therefore this late market cycle dynamics didn't quite play to the full extent, because the bubble was elsewhere, and eventually it popped in credit markets first, and then of course it dragged down the economy, and with that the equity market as well, though it never really got overvalued. So 2007 was a lesson in looking beyond equities, to know when to start removing risk, because it's not always a market event causing a peak, it's sometimes something else entirely. And the new product I mentioned earlier, Global Financial Trends, aims at helping our clients to do just that.
To track the liquidity and changes in liquidity. So we made the comparison here and detailed valuations in 2000, 2007. So what's the current cycle like? Is it more like 2000, or is it going to be more like 2007?
We think it's more likely to resemble 2000 because, first of all, there are no obvious signs of the global imbalances that led eventually to the global financial crisis. Savings glut in certain countries leading to excessive investment in the notorious mortgage market, subprime mortgage market in the United States, and with all that enticed. But there is plenty of evidence of risk-taking picking up, which is more similar to 2000. So if you look at, for example, the charts on slide 9, starting with the right-hand side, chart 8.
2017 likely to remain unmatched.
Exactly. So we're starting to see investors' behavior turning a bit more irrational. So if you look at, for example, the chart on the left-hand side, volatility in 2017 was as low as it's been since 1990. This is the VIX we're looking at. So it's unlikely that we're going to match that sort of performance with volatility staying so well behaved.
But you've already said we don't see a volatility spike coming.
We don't expect a spike until the market tops, but we expect volatility to pick up from here, simply because it's unlikely to repeat itself. And also, if you look at the returns for the MSCI World and the MSCI Emerging Markets, which is the chart on the right-hand side, every single month in 2017 had experienced positive total returns for the MSCI World, and only one negative month for the MSCI Emerging Market. So these are kind of situations which are unlikely to be repeated, and probably due to investors becoming a bit too excited about things. But despite this, we see no signs of irrational exuberance just yet. So what we were talking about before, that the ingredients for a bubble, the paradigm shift talk, we're not seeing that just yet, and we can't see it in the data either. So if you turn to page 9, the chart on the right-hand side is the State Street Investor Confidence Survey, and this basically captures real trades by large asset managers, and normally when the confidence measure tends to get much higher than 100, that's where investors are getting a bit too bullish, and there's obviously no evidence of that.
Right.
In fact, if you look at Europe, it looks as if the market is slightly underinvested. So
this doesn't capture retail. This is
professional pure institutional investors. Yeah. And of course, the earnings season is only just getting started, but so it's very early to draw any conclusions. But the interesting thing is that if you look at the chart on the left-hand side, earnings revisions have been surging, particularly in the United States, but they're positive pretty much everywhere in major markets. So the peak doesn't seem to be just around the corner yet. There are fundamental reasons to believe that there's more life left in this cycle.
Okay, so clearly we remain very bullish on stocks, but what about broader asset allocation? So could you just run through the major asset classes? What have we changed recently? What are our best picks in what's very clearly a risk-on environment?
Sure. Well, the main change we've done this month is to become a bit more bullish on equities. And of course, this being asset allocation, it means you have to be a bit more cautious in other asset classes. So in terms of equities, we've made 5 net upgrades this month. So 6 upgrades and 1 downgrade. We raised 2 markets 2+2, which is the US and China. Then Canada, Switzerland, Australia, and South Africa were raised 2+1. And the only downgrade was India, and it's just down to neutral.
Thanks. So for new clients, could you just quickly explain what we mean here by +2 and
Sure.
+1, so they get a sense of what we're talking about?
Of course, these are absolute calls on the total returns we expect from these markets, expressed in units of volatility, pretty much.
Okay, and if you don't or haven't received asset allocation published on Friday, send an email to questions@tslombard.com and we'll send it to you straight away. So the upward revisions there, you said US, China, Canada,
Switzerland, Australia, and South Africa. So US and China, they're proper growth stories and very much tech-driven, which is the point I was making earlier. Canada and Australia, they are similar stories driven by the improvement in commodity prices and the benefits of having a very large and nicely performing trading neighbor. And likewise, Switzerland, if you want, and South Africa is also a beneficiary of higher commodity prices. When it comes to India, it's mostly about underperformance. We think probably returns are likely to be positive here as well. But we think that the market will lag other markets because of the risk of a populist agenda by the Modi government.
right, and the fiscal issues and the inflation beginning to come back again.
Exactly. And then, of course, higher oil prices are not particularly good for India either. So as a result of these changes, we've increased our model portfolio equity weight by 5%. So we continue to be overweight both developed and emerging markets, and that means we are underweight fixed income.
Right. Okay. So more on fixed income there. Does that mean we're outright bearish?
We are not across the board. So on government bonds, we definitely remain bearish, though not for the same reasons as last year. So last year, our view was predicated on expectations of rising inflation, which there was some of, but not as much as we thought there would be. But for 2018, our inflation view is more benign. We think that inflation is structurally lower because of the sort of holy trinity of low inflation, which is demographics, globalization, and technology, keeping wages low. What we think has changed from last year is central bank liquidity. Okay. And we've mentioned that before, and we think that that's going to have a major impact on bond markets this year, and it's already started doing so. So if you look at page 10, the chart on the left-hand side is a principal component analysis of fixed income markets, equity markets, and FX markets. So each line represents the amount of performance explained in these markets by the first factor in the principal components analysis. And you can clearly see that in fixed income, a lot of the performance continues to be driven by one factor, which through different techniques you can clearly identify as QE. Now, QE is what's going to change this year. So we know that the Fed is going to do QT. It's already actually started doing that already. The pace of balance sheet reduction has actually been slow. It's pretty much very much slower than the maximum pace they could have realized already so far. But it should pick up, and we will make this point today in the macro strategy publication, which is going out at 3 o'clock, or shortly after 3 o'clock. The other big change will be the ECB, because we know QE will probably end in September. We believe it will end in September, and we think that the ECB will start hiking rates already in December. So policy will get tighter in Europe as well, and
less loose.
Less loose, definitely less loose. Let's put it that way. Yeah. If you look at the chart on page 11 on the left-hand side, that clearly shows that the ECB QE is the reason the term premium in treasuries is depressed. Or at least there's a very strong correlation between the rolling 12-month ECB purchases and the 10-year treasury term premium, which is on the right-hand side on an inverted scale. So the higher means it's a lower term premium. So we think that as these purchases eventually fade, the term premium should normalize, and that should lead to higher treasury yields. We don't see a bear market in bonds this year. Many commentators, some high-profile commentators, have been pointing out that the bull market in treasuries which has lasted more than 30 years has ended, and that's probably true. But we expect more of a sideways market than a proper bear market.
Have you got a best guess or a forecast therefore for 10-year yields at the end of the year with 260 now?
Yeah, we think something around 3%, probably a bit more than 3% is a realistic estimate.
Okay.
We covered that in a recent US watch, and we can point that out maybe to our clients later.
And what about the demand for treasuries, the China influence on the price?
Yeah, there was a story in Bloomberg probably last week or a couple of weeks ago about the possibility of China selling its US Treasury holding, and we think that the story has been greatly exaggerated. First of all, the amount of treasuries held by China is only 7% of the market, so it's a big share, obviously, but it's still a relatively small fraction of the market. But it's mostly driven by reserves, and reserves. So that can be seen on page 10 on the right-hand side.
Yeah. Okay. Page 10. Clearly, China treasury holdings versus FX reserves.
So China buys treasuries because when it accumulates FX reserves, it uses them to buy treasuries, and we can already see that FX reserves in China have started going up again after the big reduction of the last couple of years. So the outflows have eased in China, and that means that the need to compensate for that by liquidating reserves to keep the currency in check is no longer there. So we think that Chinese FX reserves will continue to increase, and therefore the pressure on to sell treasuries should also be diminished. So any reduction in treasuries, if at all, will be small, gradual, and on only 7% of the market, which isn't very much to start with.
Okay, and we haven't yet referred to gilts. What do we expect for gilts this year? Now we're clearly going to get a Brexit transition deal. Economic growth is solid, although some are starting to worry about consumer debt and house prices and so on. Have we got a strong view on gilts for this year?
Yes, we are -2 on gilts, so that's the market where we expect the lowest returns, in fact negative returns. We think that the consensus assumptions on UK growth are too negative. We are definitely above consensus on that. Of course, inflation remains a problem. That will probably ease because sterling has been appreciating quite strongly, at least against the dollar over the past 6 months, but not so much against the euro. So we think that inflationary pressures will remain in place, particularly because the job market in the UK remains quite buoyant. So I think growth will hold together quite nicely, and therefore, a combination of inflation and repricing of expectations should lead to the gilt market to underperform other major bond markets.
Okay, and what about the other majors? What are we going to see in terms of bond yields? And you've already referred to what we think will be less dovish or more hawkish Bank of Japan.
Sure. Well, in the euro area, bond yields will be very much affected by the end of QE. We think that that there's very significant distortions in the bond market because there's been a very limited supply to begin with, and the ECB was buying a very large quantity of bond yields, absorbing all the net supply of bonds. In terms of, it's also important to note that the Bank of Japan QQE program is pushing down yields. So if you take a look on page 11 on the right-hand side, this chart shows the Japanese 10-year yield plotted against the Bund 10-year yield hedged in Japanese yen.
Okay, right. So it is hedged.
Exactly. So as Japanese JGB yields have started to fall since 2010, Japanese investors have started buying bonds and hedging their exposure, their currency exposure, and they would still be able to take a significant pickup over JGBs. More recently, that pickup has become close to zero, and that's been the case for the last couple of years. But it keeps bonds from appreciating, because the moment bond yields go up, since the interest rate differential between yen and euro is still negligible, and therefore the cost of hedging is quite limited, Japanese investors will buy. So that stops bonds from bond yields from going too high. But of course, the end of ECB QE should remove a lot of demand, and that should lead to yields going up. But we don't expect yields much higher than 1% by year end.
Okay, and we're at 60 bips or thereabouts at the moment.
Exactly. Elsewhere, euro area spreads, well, as long as the cyclical upswing continues in the euro area, we think they should remain low. Again, spreads are a short volatility trade. We expect volatility to remain relatively well behaved. Now, a special case might be Italy. Of course, the elections are coming up in March. But if you look at the widening that took place after the election date was announced, that's already been completely undone. And if you look at the Italy CDS, and particularly at the spread between the 2014 documentation and the 2003 documentation, this is quite technical, but basically this spread captures the redenomination risk. Well, that's fallen from 66 basis points in mid-2017 to 37 basis points now. Now, we saw the same dynamics in France before the elections last year. That spread that widened, and then it was completely reabsorbed after Macron's victory.
Yes.
We expect the same dynamics to continue to happen in Italy as well. There's no party any longer pushing for a euro exit. So that's
the reason for this compression.
That's right. So the risk of a euro redenomination of Italian bonds is quickly fading away. In terms of credit, we continue to like investment grade and high yield. These two are short volatility trades, so that view is predicated on volatility remaining well behaved. What we think is that spreads will not get much tighter from here, and they will likely keep bouncing off the cyclical lows, which have already been reached, or maybe are not much lower than where we are now. But the spreads will continue to provide a good carrying roll down. In terms of total yield, so for those investors who can't take just exposure to the spread, but to the whole yield, of course, high yield is more appealing than investment grade because it provides a bigger buffer to absorb the increase in government bond yields that we expect. In terms of emerging markets, we remain selectively constructive. The recent surge in EM inflation has started to abate, which is a strong positive factor for emerging market debt. This decline in inflation probably won't last very long, but in the near term, it should be a positive.
Okay, great. And speaking of near term, I mean, the dollar's been weak and weakening for some time, but it's the rate of the fall has accelerated quite dramatically in recent days. What do you make of what's been going on with the dollar index?
I think it's interesting to look at page 12 in the slide deck. Well, we think that the dollar is going to stay on the back foot despite the recent weakness. Fed policy has been consistently mispriced by the market over the past few years. That's no longer the case. So this continued repricing of Fed expectations was a supporting factor for the dollar, and that's pretty much disappeared. We think
over the last couple of years, we were actually calling for more hikes than the market was expecting, and sometimes more than the Fed was it.
Exactly. And now the market
repriced a few weeks or sometimes even days before the announcement, whereas now we think the markets have got it right.
That's right. So the market's pretty much in line with our expectations, with the Fed as well. So we think it's pretty much right. But of course, there's other factors as well. So, for example, if you look at the chart on the left-hand side on page 12, the euro area broad basic balance of payment has been increasing and turning positive recently, and the Chinese financial account has also turned positive. So, global demand for dollar is diminishing. There is less demand for dollar.
So a few months back, when we were getting a lot of questions from clients, and we still get a few, albeit less, about global dollar, offshore dollar liquidity, that should be less of a concern because of these current account balances in Europe and China.
That's right. So there will be tighter offshore dollar liquidity as the Fed continues to do QT, because of the reduced amount of collateral provided. But it should be less of a problem for these dynamics here. And global reserves, and that's the chart on the right-hand side, have started going up again, which means there is demand for dollar assets. But interestingly, the non-US dollar allocation has been increasing. So the demand for dollar assets has probably been less than people thought looking at global reserves, because people want more non-dollar denominated assets than before.
Okay, so demand for dollars is falling and will continue to do so. Therefore, that's one of the reasons we expect continued dollar weakness. What about the euro?
Well, on the euro, we remain very bullish. We've actually upgraded the euro to a +2 recommendation in asset allocation this month.
So what type of move does a +2 recommendation?
Well, it's probably about 10%, but that's annualized over the next 3 to 6 months.
Yes. Okay.
The euro is no longer super cheap as it was maybe a couple of years ago, but it's not expensive either. And of course, it's maybe slightly cheap for Germany, it's slightly expensive for Italy, but generally speaking, it's still, it's about fairly priced. So valuations are not an impediment for the euro to rise. So for now, the main driver of euro performance will be growth to some extent. So if you look at page 13, you can see how consensus expectations of GDP growth have been soaring for 2017, 2018, and 2019. So clearly, the market's still catching up with the euro strength, which we've been talking about for a long time.
Yeah.
But consensus was quite reluctant to buy into. And also the financial flows will play a much greater role. So we've seen that broad basic balance of payment chart earlier. So what's been happening over the past few years is that Europe's very large current account surplus was offset completely, and at some point even more than offset, by capital outflows, as bond investors in the euro area sought higher returns elsewhere.
So as a result of QE?
It was a result of QE. As QE ends,
push people out.
Exactly. So as QE ends, those flows have slowed and will probably invert. And therefore, there will be no longer a major outflow of financial flows offsetting the current account surplus. So that's probably going to be the main performance driver going forward. And the market, differently from what's been reported, is actually not that long euro yet. So CFTC data has been cited as a clear evidence of the market being very long the euro. That's true for long-only accounts. But if you actually look at the relative performance between positioning and euro dollar, that's the chart on the right-hand side on page 13. It's actually speculative leveraged account positioning that drives, or at least that correlates strongly with the euro dollar, not so much the real money account. So one has to look at the leveraged positions, not the long-only accounts. And if you look at those, as you can see from the chart, they are on the long side, but not particularly long. So the market is not really very long euro, at least not for the part that's more correlated with euro performance. So a long position is building, but it's not there yet.
Okay, so to try and sum up, before one final question, then clearly we're very bullish euro. We are anticipating further US dollar weakness. We think that it's fixed income is going to struggle this year, but no bear market. We started off talking about equities, our very strong bullish view on equities, that we're not yet in bubble territory. The final question, therefore, that's come in from a few people is, at what point do we think, how will we judge when we have entered bubble territory, and when will it burst?
Well, that's a very difficult question to answer. I guess we have to probably go back to the chart on page 3, which looks at valuation. So clearly the next reference point, something that is kind of something we can rely upon, is the bubble of 2000, 1999, 2000. So if we were to get anywhere near those levels in terms of CAPE, that would be clearly a sign of things having gotten out of control. Probably the market will feel very toppish before we get there. So we are looking to a sort of boom bust kind of cycle with the market melt up most likely this year, and potentially a peak being reached at some point in 2019.
Right. Okay. Good. Well, thank you very much, Andrea. Thank you very much for everyone joining us today. If we haven't addressed the topic you were hoping to hear about, the email address is the same, questions@tslombard.com. And thanks very much for joining us.